It has been an extraordinary last fortnight for Asian markets. A broad-based stimulus package announced in the last week of September by Chinese authorities covered more than 10 key measures across fiscal, monetary, property and equity market areas, and they were seen as so significant that it led to some analysts, including those at Goldman Sachs, calling the easing measures one of the most significant in recent global history, and even drawing comparisons to the whatever it takes speech by the then ECB President Draghi in 2012. In response, the MSCI China Equity Index rose by well over 30% in sterling terms in the 2 following weeks, before paring some of those gains in more recent days as the Chinese domestic markets reopened following the national holiday. Caution is still very much warranted within many areas of the Chinese markets. Geopolitical and trade tension risks remain heightened and will undoubtedly be sensitive to the outcome of the US election next month. The country also has severe over-leverage problems, notably in the property sector, but perhaps even more importantly, the alignment between profit-making companies in the country and the government's desire to control and need to limit spending has and will likely continue to have an impact on long-term shareholder returns. However, undoubtedly, these stimulus measures represent a notable change and are impactful for the health of the entire Asia region. And so over the next few weeks, we intend to catch up with a number of Asia and emerging market asset managers for an insight into how sentiment is changing in the region. And we start today with Douglas Ledingham from Stewart Investors. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killick.com. In today's episode, we were joined by Douglas Ledingham, a senior portfolio manager at Stewart Investors. Douglas joined the team based in Edinburgh in October 2013, and he's the lead manager on the company's Asia Pacific and Japan strategy. And alongside David Gait, also co-manages the London-listed Pacific Assets Trust, ticker PAC. This is the circa 460 million market cap investment trust which invests in companies in the Asia Pacific region, including the Indian subcontinent, but excluding Japan, Australia and New Zealand. Our discussion this week focuses on a number of broad topics related to the team's strategy. However, for listeners wishing to get a greater insight into the companies currently making it into the Stewart Investors portfolios, the asset manager recently developed a Portfolio Explorer tool, accessible via their website, which describes the investment case behind constituents of each strategy, in addition to explaining the sustainable development stories of each company, an important element of the approach which we discuss in our conversation. We've included a link to the tool in the episode description, but as always, please do get in touch using the podcast email address to let us know any feedback you have on the series and if you'd like any further information on any of the topics discussed in this episode. Douglas, good afternoon. How are you doing today?
I'm good. Thank you very much for having me.
Not at all. So we've got this kind of standard opening question to these, which we've been asking everybody, and what its aim is to get a bit of an insight into you, really, or kind of how you go about your work. I wondered if there's a kind of research project that you've been working on, or an anecdote from a recent meeting, or even just an article or book. We've had kind of book recommendations here. Anything you can share just to give a bit of an insight?
Yeah. So a lot of what we do, day to day here is a lot of debate that goes on. A lot of debate, both face to face with my colleagues in Edinburgh, but also, lots over email with my colleagues in Sydney and Singapore. And, this week, again, very, very diverse collection of conversations and debates, which is, one of the reasons I love this job so much. one of them this morning talking about the corporate restructuring of a parent company of one of our Indian holdings, and a lot of deep debate on our part in terms of trying to understand what that means for us as minorities in the subsidiary. Or yesterday we met the new CEO of one of Asia's leading retailers. He's come in, he's intent on simplifying the business, selling off underperforming units, and again, a lot of what we're trying to discuss and get hold of is what could this business look like in 5-10 years if he's successful in simplifying that. And certainly that's one of the most enjoyable parts of this job is debating the impact and the change that can come around due to people and culture. And the book I've been reading recently, and this has also been reinforced by a couple of papers, I'm certainly massaging my own biases, but one book that I've been reading recently is The Culture Cycle by a guy called James Haskett. And it's really a book that explores, the various ways that a quality culture can lead to, meaningful and robust kind of performance differences between companies in the same industry. And that, in our view, that certainly always chimes from an ability to think differently, and usually comes down to something as simple as just being able to take a long-term view. And, that's really been highlighted in reports by, Credit Suisse or McKinsey, and, a lot of work done on showing that over the long term, over various time periods, various countries and various sectors, that family-owned companies outperform non-family-owned companies. And it's something that really doesn't get a lot of headlines. It's certainly something that's not picked up, in investment bank reports where you can read up 100 pages and they've probably got 3 sentences on who owns a company. But certainly we spend a lot of time trying to understand who we're handing our clients' money to, and you'll see that a lot of that is invested in family-owned companies, and it's really due to the fact that we believe that these institutions and these families can think differently and can focus on building great businesses for the next 10 years rather than the next 10 months.
Yeah, no, really interesting. Yeah, thank you for that. Good book recommendation as well. I'll add that to the list. That actually leads quite nicely on to my next question, really. It's talking about family-owned businesses. I know that's kind of is a big focus for you, but I wondered, just to kind of frame the discussion, really, if you could kind of give us a brief summary of those kind of characteristics, those other characteristics which kind of typifies a Stewart Investors holding company. Because you kind of look through your portfolios, and there's quite large chunks of it of the index which you kind of wouldn't typically own, but there are characteristics that are kind of very common. Could you kind of talk us through those?
Yeah. So I mean, hopefully when you look at the Pacific Assets portfolio, that you are seeing a reflection of a truly bottom-up active approach, where we are very much focused on compounding clients' capital by owning great businesses for the long term, rather than us, investing in the index or trying to be too smart and trading in and out. So, really the results of our philosophy, one that sees risk as a risk of losing clients' money, and one that really focuses on the long term, is, a portfolio that looks and behaves very differently to the index. So the average holding period for the PAC-Assets Investment Trust is 10 years, and over 65% of the portfolio we've held for over 5 years. And, if you are thinking about allocating clients' capital for the next 10 years, it tends to, as you say, lead to certain biases that we have in what we want in our companies. And over 80% of the companies that we own, as you mentioned, have an entrepreneur or a family or a foundation that has a material stake in the business. And that's really just a simple desire on our part to take, the trust's precious capital and really hand it to people that, first of all, that we trust, not to run away with it, but that have the ability to invest in making the business better over the next 10 years. And that really encompasses how they think about, sustainability positioning, how they think about the quality of the balance sheet, how they think about the relationships with, customers. And that already, that feeds into, so, we've touched on families. The companies that we own tend to have very strong pricing power as a function of the quality of the products and services that they're offering. And also as a result of great businesses with great cash flows, and people at the top who have been around a long time and have their own money invested alongside us. They have very strong and robust balance sheets. So the vast majority of companies in the trust, again, have net cash balance sheets, so more cash than debt. And that is the result of the people managing our businesses that have seen the Asian financial crisis, they've seen the dot-com bubble and crash. They've seen interest rates of double digits, inflation rates of double digits. And how then do they build a company that can survive and prosper in most macroeconomic environments? And, they really are focusing on having great customer relationships, great balance sheets, and, and trying to, as much as possible, ignore, short-term pressure and noise. And that's certainly something that we get really excited about, is being able to find these rare companies and, invest the trust capital alongside these people.
Yeah, no, for sure. Yeah, no, that all feeds through into the kind of return profile of the trust itself, kind of being more resilient, not typically being more resilient in those kind of weaker periods, and that's how you kind of built the track record. Douglas, my next two questions relate to those kind of two big component parts of the Asia index, being India and China. And one of the things, I guess, that's characterized returns from the region recently has been the dispersion between those two countries. I wonder if we can maybe take each of them in turn and kind of run through your approach and the opportunity you're seeing in both of those. Can we maybe start with India? I know it's been a kind of country which is kind of, you've long had a kind of overweight to, and you found a kind of deep pool of potential investments, but we have had such a strong run, a big portion of which has been kind of multiple valuation expansion. Could you maybe kind of talk us through, give us an update on your positioning there, and perhaps there's some examples where you're kind of currently seeing attractive opportunities you could talk us through?
Yeah, sure. Yes, I mean, as you said, so India has been home to a large allocation of the trust capital for the last 10 years, and that really is a function of it being home to a really deep, broad pool of wonderful companies run by, fantastic people. And it's not driven by a kind of top-down view of politics or GDP on our part. I mean, something that I think is important to reflect on is that, yes, the allocation of the last 10 years has been significant to India, but really the underlying companies have evolved over that time. And again, that's one of the most wonderful things about India, is that the opportunity set is constantly evolving. So 10 years ago, the trust would have been heavily weighted towards consumer staple names and the generic pharmaceutical names. Today, you'll see there's a far greater weighting to industrial companies. And, for us, you'll see the trust as a significant portion of its capital invested in these names. And, we're really excited about the opportunity set over the next 10, 15 years. These are industrial companies run by world-class management teams that are very aspirational. And these companies are a fraction of the size of their global peers. So, why are we allocating our clients' capital to these companies for the next, hopefully, 10, 15 years? Is that great businesses exposed to very attractive structural growth in a large domestic economy. But really, it's what takes it to the next level is the global aspirations of these companies. And the last 10 years, there's been a lot of investment in manufacturing quality and brand building. And it really, for us, that's really set the stage for these companies like CG Power, Mahindra Mahindra, Tube Investments, the large Indian holdings in the portfolio, just to really benefit from not only that domestic growth, but taking market share from, large global multinationals who potentially are a bit slower now and a bit easier pickings for these kind of smaller, more aspirational, really, hungry Indian companies. As you said, there's certainly aspects of the parts of the Indian market that are very expensive, and these tend to be the smaller cap names with exposure to the CapEx cycle. But, we are very fortunate as, truly bottom-up investors to be given the opportunity to look anywhere in India for great opportunities. And we certainly don't subscribe to the view that you can pay, any multiple for a great business. And certainly you overpay and you get really mediocre returns. So, valuations is a key part of how we try to manage risk, but we tried not to get sucked into a really short-term, almost myopic focus on short-term price-to-earnings ratio. Instead, we tried to take a step back and ask ourselves, what are these companies worth to us over the next 10 years? And that really allows us to use our imagination and our ability to lean into qualitative analysis and compare these companies versus global multinationals and their size, and imagine what they could be, and then ask ourselves, what could that return profile look like if this is a success? And certainly we believe that the opportunities for these companies over the next 10, 15 years are wonderful. That's why, we're very comfortable having a significant portion of the trust's kind of precious capital invested in these companies.
Yeah, no, thank you for that. Some really interesting points in there. Really quite interesting to hear you talk about the kind of evolution of India within your own portfolio as well, from kind of consumer staples to industrials and a few other areas. So, yeah, thank you for that. We have to talk about China. We are kind of catching you after a pretty remarkable last couple of weeks, really, after that kind of stimulus package from the Chinese authorities. But I appreciate in some of your commentary you've indicated that you've been spending quite significant time kind of reassessing some of these Chinese businesses. Could you provide an update of kind of where you're exposed there? Some maybe some examples of businesses are making it into the portfolio.
Yep. So you'd seen, if you reflect on what the trust looked like over the last 15 years, there has always been a relatively small allocation to China, and that has just been a reflection of a far smaller group of companies that meet our quality credentials. A large part of the market is dominated by state-owned or state-controlled companies, and for us, who as a team who spend a lot of time thinking about who we're handing our clients' money to, it's a relatively simple decision on our part not to hand it to state-owned companies or state-controlled companies where that risk of material loss is significant. Now, the kind of companies that we do get excited about investing the trust capital in, they tend to be smaller companies that provide a long runway of growth before they reach the kind of commanding heights of the economy, where we have seen historically across sectors, the larger you are, the greater the focus there is by the regulator on the state on perhaps what you're doing as a business on your profitability. So the companies that we own tend to be smaller. They tend to be in sectors that we believe need to survive and prosper for the Chinese economy to develop over the next kind of 10 years. And so we have, one example would be China's leading software company that's selling into the construction and manufacturing and infrastructure sectors. They have a dominant position. They are solving customers' problems in regard to improving efficiency, reducing time delay, improving safety, and they are selling their software on a recurring basis. So there's a very attractive cash flows that come in. And when we can compare, this company is called Glodin. If we compare Glodin to their peers in the US, there's a company called Autodesk, or in Europe, there's a company called Nemetschek. Both are providing software that's very similar to Glodin's, and they're solving similar problems for their customers. These companies are materially larger and materially more profitable, and we believe that Glodin, thanks to their dominant position, their investment they make in R&D, the fact that they now have a professional CEO at the helm who came from Autodesk, these are all like characteristics that we're really enthusiastic about, that we think that should set Glodin up to be materially larger over the next 10, 20 years. And we're currently paying a multiple that we think should deliver attractive growth, kind of no matter, or it reduces the need for us to try and guess what sentiment's going to look like in China over the next 6 months or year. This is a great business with great cash flows where the management team's investing for growth. And we're very, very comfortable in just sitting there and being long-term owners of this business. So although there's big chunks of the market that we say no to very quickly in China, there are, a set of companies that we can invest in and we get really excited about. It just has been, for the most part, these companies have been relatively expensive. And really over the last 6 months, valuations have collapsed in China. It didn't really matter what the company did, who owned the company, what the valuation was. All these share prices look the same, and that's a very attractive position, as a bottom-up stock picker. So yeah, we have been able to increase the trust weighting to the largest actually in China it's ever been, at 13%, including Hong Kong. And, that compares to less than 10% last year. So we have, nothing tends to move very quickly at Stewart Investors, but hopefully you do see that we have been able to, take advantage of the relative despondency around great companies in China.
Yeah, no, that's clear. Yeah, that's a good example of how your process works. Douglas, I wonder if we could just talk briefly about the sustainability disclosure requirements or SDR. I mean, partly because it's quite topical at the moment. I know the company recently took the decision to remove that word sustainability from the open-ended funds, and I think Pacific Assets Trust actually just had its half years just this morning, and I know the board kind of discussed the changes to the objectives and how you're kind of not doing anything at the moment.
Yep.
Could I ask you to just maybe briefly explain the approach you've taken to that regulation change?
Yeah, so you're taking going back in history. So we have always thought about sustainability and included it in how we think about risk and reward. For us, it's just a very natural outcome of taking a long-term time horizon. It was in 2005 where we first included sustainability in the name of our open-ended vehicles, and that was the result of conversations with clients about how passionate we are about investing in companies that are well positioned for sustainable development. And clients coming back saying, "Oh, that's all well and good, but what are the returns I've got to give up to be able to invest like that?" We were like, "Whoa, no. We see it as a driver rather than a detractor of returns." So, to push back on that, we put sustainability in the name to really prove to the industry that thinking this way is a driver of returns rather than a detractor. And you kind of fast forward 19 years, and yes, we decided to remove the name, and there's probably a few reasons for that. So the world's evolved. We want to be known. We want Stewart Investors and Pacific Assets to be known for their long-term focus on allocating their clients' capital and their passion for including sustainability as a part of that. The companies that we really admire, they don't have sustainability in the name. They don't have, Patagonia is not Patagonia Sustainability. So we really want to be known as Stewart Investors rather than, Stewart Investors Sustainability. Coming back to that point in regulators, certainly, globally, regulators are trying to define what sustainability means, and each regulator is coming up with, with their own approach. And I think having sustainability in the name just creates regulatory confusion rather than clarity. And, we would much prefer to be focusing on improving our own approach to sustainable development, really, reflecting on how we can lead and how we can be transparent and how we're allocating clients' capital. And I think just having sustainability in the name just, became more and more of a hurdle of being able to do what we wanted to do. And certainly we would never change our philosophy to satisfy a label. So that was a very simple decision for us. And I suppose, finally, sustainability is just one part of how we think about the long-term allocation of clients' capital. Quality and the quality of people, the quality of franchise, quality of financials are equally important to us in terms of how we think about allocating capital over the long term. So, it's that was perhaps putting too much emphasis on the sustainability part and maybe removing us from certain conversations, that could be had in mainstream investing. A bit of a change in regard to the name and us not going for a top label, but for our, for clients, there really is no change in terms of how we think about allocating their capital. They're very much a kind of cosmetic change.
Yeah, that's clear. Yeah, no change whatsoever to the philosophy.
Yeah.
Douglas, our last question is another standard question, and I hope it's not the trickiest one of the set, but it's one that just asks for the speaker's kind of highest conviction area at the moment. It doesn't necessarily have to be a single stock; it could be a kind of area of the market. I wondered if there was one particular area that you would highlight as being particularly positive on at the moment.
So certainly, when we always want the portfolio to reflect where our highest conviction is. So you can see that in the Indian names. Despite the strong run that India's had, that has been driven by strong underlying resilient earnings growth. It's India has done well because it's managed to grow. Compare that to China, and the index is down partly because there's not been any underlying growth in earnings. But so we're not owning India Incorporated or China Incorporated. We have the ability to to be truly bottom up and find great people to hand clients money to. And coming back to that point on what's going on in India, and our ability, given our focus on people, it does lead us to different opportunity sets than perhaps quality investors that may be purely focused on quantifiable metrics. I'm really excited about what's going on in some really interesting franchises in India with change in management teams and the evolution that they're trying to set these companies on. And I certainly think that's one of the benefits that we have in terms of our time horizon and our qualitative approach, that we can take that step back, have conversations with management teams, really probe them on where they would like to see the business, where they've studied elsewhere, and what they would like to replicate. And it's really with that we can back management teams to change the quality of a business and change the trajectory of a business. And really in India, there's a number of names that fall into this category where we are really backing world-class people to build what we believe to be truly fantastic franchises over the next 10 years. And that requires in us that ability to take a long-term view and really back people and be long-term owners. And coming back to that point at the beginning in terms of the average holding period in the trust being 10 years, that's just as a simple thing to say and a simple number to put on a spreadsheet or a presentation, but it's very difficult to achieve in reality. It requires a lot of, as I said at the beginning, a lot of debates, a lot of challenge, but ultimately not fiddling with the portfolio. And really the onus on us is as much as possible to really back these management teams and prove that we can, walk the talk in terms of being long-term allocators to the region.
Yeah, thank you, Douglas. Yeah, really interesting. Really timely point to catch up with you. So thank you for your time. I appreciate it.
Thank you very much.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com. For more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.